Well, there's been a lot of talk lately about this sudden surge in silver after reports that the United States may be stepping back from striking Iran for the next 2 weeks. So in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and a lot more confident about what you're looking at on your screen. It is Wednesday, April 8th in New York. And before we go any further, comment what day and date you're watching from. And quick note, if you value this kind of content, support it by subscribing and commenting, John A.G. Best. So, in case you haven't seen the chatter I'm talking about, it all sounds something like this. The crisis is over, silver is exploding, oil is collapsing, the danger is gone, and the metals market has finally been given the green light to run. And on the surface, I understand why that story is spreading so fast. You've got a headline about a pause in strikes, you've got talk about back-channel diplomacy, you've got a possible negotiating window, and then you look over at the market and silver's moving hard, gold is moving too, and oil is getting hit like somebody pulled the floor out from under it. That is the kind of combination that gets people emotional very, very quickly. However, when we slow this down and take it apart piece by piece, there are a few things that do not line up as neatly as they first appear. Not because nothing happened. Clearly, something happened. Markets do not move like this for no reason, but because people are trying to cram a very messy situation into a very simple headline. And when that happens, investors usually end up reacting to the story they want to believe instead of the one the market is actually telling them. So let's start with the basic claim. The claim is that a reported 2-week suspension in U.S. attacks on Iran, along with diplomatic pressure and a new proposal on the table, is the reason silver took off. And yes, that's the center of the move. But it is not the whole move, not even close. Because when you look at the bigger backdrop, silver was not just responding to one geopolitical headline. It was also responding to a market that had been stretched, whipsawed, and frankly exhausted by weeks of oil panic, dollar swings, shifting rate expectations, and the constant threat that the Strait of Hormuz could stay disrupted longer than traders were comfortable pricing. That matters, because silver does not live in a vacuum. It never has. Silver is part precious metal, part industrial metal, part inflation signal, part fear trade, part momentum trade. Sometimes those forces line up. Sometimes they fight each other. And when people act like silver only moved because peace is bullish, I think that misses what is actually going on here. Because if this were simply a clean peace dividend, you would expect volatility to cool down a lot faster than it has. You would expect the fear trade to fade more cleanly. You would expect everyone to agree on what happens next. And that is not what we're seeing. From recent market updates, crude got hammered after the ceasefire headlines, dropping back under the triple-digit area after spending weeks screaming higher on supply fears. But even after that drop, energy is still sitting well above where it was before this war shock really took hold. So yes, the market got relief. But relief is not the same thing as normalization. That distinction is huge, because markets can celebrate the avoidance of a worst-case outcome, while still pricing in the possibility that the next headline puts the fire right back on the table. And silver, in my opinion, is reacting to that exact tension. On the one hand, a pause in bombing reduces the odds of an immediate energy spiral and a straight-line inflation shock. On the other hand, a pause is still a pause. It is not a treaty. It is not a settled region. It is not the kind of thing that lets everybody exhale and go back to sleep. So what you get instead is a market that says, okay, maybe the very worst outcome just got pushed back, but I still need a hedge, I still need optionality, and I still don't fully trust this. That can be very good for metals, especially when the dollar softens at the same time. And that is another piece people are rushing past. The dollar has not exactly been acting like a fortress here. Recently published market numbers showed the dollar index slipping, while gold and silver were firming up, and that combination matters a lot more than people realize. Because a weaker dollar doesn't guarantee a metals rally, but it absolutely makes it easier for one to happen, especially when rates stop pressing higher and the market starts thinking maybe the inflation panic does not need to be repriced upward every single day. In other words, the metals move is not just about one region. It is also about the pressure easing in several places at once. Now let's talk about the geopolitical part, because this is where people start jumping from reported pause to problem solved, and I think that leap is way too aggressive. The broad report is that there is a 2-week window, that strikes are being suspended, that diplomacy has been given room to work, and that Pakistan helped create space for that process. Fine. That is meaningful. I'm not dismissing that. Anytime you go from imminent escalation to even a temporary opening for talks, that is a market-moving shift. But temporary is the word. 2 weeks is not the end of a conflict. 2 weeks is a pressure valve, and a pressure valve can absolutely move markets. It can move them violently, but it does not automatically rewrite the structure underneath the market. The Strait of Hormuz is still one of the most sensitive oil choke points in the world. According to official energy data, roughly a fifth of global petroleum liquids pass through that corridor, and there are not many easy substitute routes if it gets jammed up again. So when traders saw the possibility of traffic resuming and the immediate strike threat easing, they repriced oil hard. That makes sense. What does not make sense is pretending the underlying vulnerability disappeared overnight. In fact, one of the more important fresh pieces of context here is that physical oil markets were already under enormous strain before this reported pause even showed up. Recently published reporting described cash barrels trading under much tighter conditions than the futures market alone would suggest, and shipping confidence had already been badly shaken. So even if futures fall fast, the real-world machinery behind energy supply does not magically heal in a single news cycle. Tankers still need confidence, buyers still need certainty, insurers still need to believe the route is stable. And until that happens, there is still a layer of risk floating over the entire macro picture. That is why I do not buy the lazy version of this story, which is that oil down automatically means metals should cool off too. Sometimes yes, sometimes no. Because if oil falls due to improving supply confidence, that can reduce inflation fear. But if metals are rising at the same time, that can mean the market is doing something more nuanced. It can mean traders are rotating out of one form of geopolitical stress and into another form of protection. It can mean the market is rewarding the idea of lower energy pressure while still refusing to fully trust the ceasefire. And that, to me, fits the price action a lot better than the cartoon version. There is also the silver-specific piece of this, and I think this is where things get really interesting. Silver has a habit of looking sleepy until suddenly it doesn't. It can sit there, frustrate everybody, and then once it catches a strong combination of macro relief, dollar weakness, and renewed risk appetite, it moves much faster than gold on a percentage basis. That does not mean it is stronger in every way. It means it is more reactive, more twitchy, more willing to sprint once people start reaching for upside. So when silver starts outrunning gold during a shock reversal, I do not automatically interpret that as a simple safe haven move. Sometimes it is partly a catch-up trade, sometimes it is a positioning release. Based on the latest publicly available futures quotes, silver was trading in the low 70s while gold pushed back toward the upper 4,000 range, both bouncing after recent stress. That alone tells you the market is not just pricing a return to calm. If it were pure calm, I would expect a cleaner handoff into risk assets and a more obvious cooling in defensive instruments. Instead, what we're seeing is broader cross-asset confusion. Equities relieved, oil lower, yields less aggressive, the dollar softer, volatility still elevated, and metals alive. That is not a one-note environment. That is a market trying to decide whether it just dodged a disaster or merely postponed one. And yes, I know some people will say, but if the bombing is suspended, shouldn't silver drop because the fear is gone? Maybe, in a textbook, but markets do not trade textbooks. They trade expectations, positioning, and second-order effects. If the market had spent days or weeks bracing for a much nastier oil shock, then a pause in strikes can actually be bullish for metals if it weakens the dollar, eases real rate pressure, and pulls investors back into the idea that central banks may not need to stay as hawkish into an energy panic. That's the kind of chain reaction that doesn't fit into a simple social media post, but it matters. And then you have the proposal angle. There is reporting that a multi-point proposal was received and viewed, at least briefly, as something negotiable enough to justify a pause. Again, whether that turns into anything lasting is a separate question. But markets do not wait for long-term certainty. They trade the change in probability. If yesterday the market thought the odds of more strikes were extremely high, and today the market thinks the odds of immediate escalation just came down, that alone can trigger a violent repricing. Not because peace has arrived, but because the expected path got less catastrophic. That is the frame I want you to keep in mind through this whole video. This is not about whether one side won the headline war. It is about how fast expectations can reset when traders are leaning the wrong way. And I think there was a lot of leaning here. Energy had become a pressure cooker, volatility had climbed. The fear gauge in U.S. equities had moved into the mid-20s, well above its usual comfort zone. Asian markets were getting hammered by the oil shock because that region is deeply exposed to imported energy. And then, all of a sudden, the market gets a headline that says maybe the immediate spiral is being interrupted. Of course, everything snaps. But snapping is not the same thing as settling. That's another point I want to stress. A fast move is not the same as a stable move. And because this headline hit after such an intense run in energy and such a charged geopolitical backdrop, the first reaction was almost guaranteed to be exaggerated. That does not mean it was fake. It means it was reflexive. Traders who were braced for one path had to reprice another path in a hurry. That can create massive candles, massive reversals, and very dramatic overnight action. It can also set up pullbacks later, even if the bigger direction still turns out to be higher. So when people ask, does this mean silver can't drop now? No, of course it can. Silver can still pull back tomorrow. It can pull back the next day. It can give back part of a shock move very quickly, especially if follow-through headlines are thinner than the initial rumor burst. The idea that one strong overnight run permanently removes downside is not analysis. That's excitement talking. And I understand excitement. Silver finally moves and everybody wants to believe the gate has opened for good. But disciplined investors do not confuse momentum with immunity. At the same time, I also think it would be a mistake to dismiss this as meaningless. Because even if the ceasefire only buys time, time itself matters. 2 weeks matters. A little breathing room matters. The difference between imminent infrastructure strikes and a temporary negotiation channel matters. And the market is clearly telling us that it matters. Oil did not collapse because traders got bored. It collapsed because the perceived shortage risk changed. Silver did not jump because somebody on the internet got enthusiastic. It jumped because several macro inputs all shifted in the same direction at once. One more thing that deserves attention is the idea that the crisis has been averted. I would be very careful with that wording. Averted for now? Maybe. Delayed? Possibly. Reduced in immediate intensity? Sure. But fully averted? I think that is far too confident. There were still reports of continued threats in the region even as markets rallied. There were still open questions about how shipping would actually resume, how long the arrangement would hold, and what exactly each side thinks it agreed to. Those are not minor details. Those are the details. So I would not speak about this as though it has been wrapped up with a bow. Not yet. And frankly, the market itself is not speaking that way either. If this were a clean all clear, I would expect volatility to collapse more decisively. But the latest volatility readings still showed traders paying up for uncertainty. Lower than the panic peak, yes, but still elevated. That tells me the market likes the direction of the news more than it trusts the finality of the news. That's a subtle difference, but it is an important one. Relief and trust are not the same thing. Now let's deal with the Pakistan angle, because that has become a huge part of the story. The broad narrative is that Pakistan played a meaningful diplomatic role in getting both sides into a temporary holding pattern. And whether you love that narrative or you're skeptical of it, the market clearly took it seriously enough to react. That said, I would caution against building the entire metals thesis around one mediator or one back-channel success. Diplomacy can open a door and still fail to carry the deal across the line. We have seen that movie before. Markets celebrate the opening of the door, then later punish anyone who assumed the room beyond it was safe. So where does that leave us if we are actually trying to think like investors instead of spectators? I think it leaves us in a place where we acknowledge three things at the same time. First, the immediate worst-case escalation looks less likely than it did before the pause. Second, the market response in metals is real and not random. Third, the rally does not prove that the underlying conflict is resolved. If you can hold those three ideas together, you'll be in much better shape than people who are only seeing one side of the tape. And this is also where I want to challenge another implied idea in the original chatter, which is that silver moved because the world suddenly became safer. I'm not sure that's true at all. I think silver may have moved because the market suddenly had to reprice a different kind of danger. Before the pause, the danger was direct escalation, immediate supply shock, and a stronger dollar squeezing everything. After the pause, the danger becomes something more slippery. Unstable diplomacy, unresolved shipping risk, higher than normal volatility, and a market trying to guess whether inflation pressure is easing fast enough to change policy expectations. Those are different risks, but they are still risks. And metals can thrive in that kind of fog. If you're successful, share your success story in the comments so others can stay motivated. I mean that. A lot of people watch these markets in silence. And sometimes hearing from somebody who stayed patient and stayed disciplined can help somebody else avoid doing something emotional. Now, let me zoom out for a second, because one of the fresh pieces of context here is that gold had already been trying to stabilize before this latest headline burst. Recent market coverage showed gold rebounding from a rough patch and climbing back toward a multi-week high as the dollar eased and Treasury yields stopped pressing the metal as hard. Silver, as usual, amplified the move once it got traction. That matters because it means the market was already setting the table for a bounce. The ceasefire headline may have been the spark, but the room was already full of dry wood. And this is why I keep coming back to positioning. The stronger the crowd leans one way, the more dramatic the reversal when the premise shifts. If traders were heavily positioned for continued chaos in oil, continued dollar strength, and continued stress across imported energy economies, then a temporary diplomatic opening was always going to hit like a hammer. It forces shorts to rethink. It forces hedges to unwind. It forces momentum traders to chase. And silver, because of its personality, often exaggerates that whole process. There's also a historical rhythm to this. Precious metals do not always peak at the moment of maximum geopolitical fear. Sometimes they stumble during the actual panic, then strengthen when the market begins to understand the secondary consequences. That could be inflation, it could be policy, it could be currency weakness, it could be risk repricing. So when somebody says, you would think it would be the opposite, I get that instinct. But markets often move on the second thought, not the first thought. The first thought was war equals fear equals metals. The second thought may be that a pause in war reduces the energy shock just enough to weaken the dollar and revive the metals complex more broadly. That is a very different mechanism. And I want to be careful here because I am not telling you this move has to continue in a straight line. It does not. In fact, I would almost expect more chop. The latest official and market data still point to a system under stress. Oil may have fallen hard, but global energy balances were already distorted. Strategic reserves had already been part of the conversation. Asia had already been facing currency pressure from higher imported fuel costs. Shipping confidence had already been damaged. None of that disappears because one headline buys 2 weeks. It just means the market has a little room to imagine a less ugly path. That room can be enough for a very strong metals move, especially when silver has been bottled up. And I do think silver had been bottled up. It had spent a good chunk of time acting like a market that wanted a reason to move, but couldn't decide which reason mattered most. Is it inflation? Is it industry? Is it the dollar? Is it war? Is it rates? Is it all of the above? Then suddenly one headline shows up that touches several of those at once. And silver says, fine, I'm moving now. That's basically what this looked like to me. Now, another question people are asking is whether this means the feared crash scenario is gone. I would not phrase it that way. I would say the most immediate version of that downside scare appears less likely than it did before the pause. That is different. Because downside does not only come from missiles and bombers. Downside can also come from failed talks, stronger follow-up data, a rebound in the dollar, a fake-out rally, profit-taking, or simple exhaustion after a vertical run. So yes, the near-term panic case seems less dominant. But off the table forever is not language I would use. And if the market does cool down a bit after this, that would not necessarily invalidate the bullish interpretation either. Sometimes the best moves start with a shock, then spend a little time digesting. People who miss the first burst assume the move is over. People who chase the burst get shaken out by a pullback. Then the market decides what the real trend is once the emotion clears. That is very common in silver. It doesn't mean every rally survives, but it does mean you should not judge the entire story off one overnight candle. There is also the gold to silver relationship, which caught a lot of attention because silver was outrunning gold. Whenever that happens, people start talking about silver waking up, and sometimes that is true. But again, I want to add nuance. A narrowing ratio can reflect silver strength, yes, but it can also reflect a short-term catch-up move after silver lagged for a while. The key is what happens after the initial shock. Does silver keep leading once the dust settles, or does gold quietly retake control? That is something worth watching over the next several sessions. And speaking of the next several sessions, this is where patience becomes important. The negotiations are supposedly being given a 2-week runway. Fine, then watch the runway. Watch what actually lands on it. Watch whether there are concrete steps, not just dramatic posts and vague statements. Watch whether shipping behavior improves. Watch whether oil stays off the highs. Watch whether the dollar continues to soften. Watch whether volatility truly starts bleeding lower. Those signals will tell you more than the initial burst of commentary ever will. Because here's the truth. A lot of market narratives sound strongest right when information is weakest. The fewer hard details people have, the more confidently they tend to tell a clean story. And that is usually your cue to slow down. Right now, there are still too many unresolved pieces for anybody honest to speak with total certainty. There are claims about proposals, claims about military objectives already being met, claims about both sides having an incentive to freeze the situation. Maybe some of that is true. Maybe a lot of it is true. But the market is still trading assumptions, not final outcomes. So, how am I reading it tonight? I'm reading it as a very real relief move inside a still dangerous environment. I'm reading it as bullish for metals in the near term, but not because everything is fine. I'm reading it as the market saying, the immediate nightmare scenario may have just been delayed, and that changes the price of oil, the tone of the dollar, and the space available for precious metals. That is not the same thing as saying the region is fixed or the rally is guaranteed. It's more subtle than that. And I actually think that subtlety is where the opportunity is, because most people don't want subtlety. They want one clean sentence. They want war bad, peace good, or oil down, silver down, or ceasefire means buy everything. But markets punish simplistic thinking, especially in moments like this. The better approach is to recognize that different assets can respond to the same headline for different reasons, and those reasons can coexist. Oil can drop because supply panic is easing. Stocks can bounce because growth fears are easing. Metals can rise because the dollar is weaker and uncertainty is still high. Those things can all happen together. That's not contradiction. That's a complex market. So yes, this is encouraging news in one sense. It's encouraging that immediate escalation appears to have been paused. It's encouraging that a negotiation window exists at all. It's encouraging that the market is no longer pricing the most explosive version of the energy shock quite as aggressively. All of that is true. But it is also true that the whole setup remains fragile, the details remain incomplete, and the reaction remains highly emotional. That is why I think wait and see is still a very reasonable posture, even if you're constructive on metals. There's even a broader macro layer here that people are underestimating. Fresh reporting showed stock futures bouncing, several Asian markets ripping higher, and Treasury yields easing as traders stepped back from the idea of an immediate energy-driven inflation spiral. But at the same time, fuel prices for consumers are still nowhere near fully healed, and some analysts are still warning that if the shipping lane gets disrupted again, the oil shock can come right back in a hurry. That means the market is not moving from danger to safety. It is moving from one set of probabilities to another. And when that happens, silver can stay interesting longer than people expect, because it sits right at the crossroads of inflation psychology, industrial demand expectations, and straight-up investor emotion. So ask yourself this: are traders buying silver because they believe the world is calm again? Or are they buying it because the market just proved how unstable the whole system still is? I think that second question is the more useful one. Because if this rally is being fed by instability rather than peace, then the follow-through depends less on celebration and more on whether uncertainty stays elevated, even as the headlines get a little less dramatic. And one last thing before I wrap up. Don't let the excitement of a big silver move trick you into forgetting how silver behaves. It is fast on the way up. It is fast on the way down. It loves drama. It overreacts, underreacts, then overreacts again. So if you're watching this and feeling like you have to do something immediately, just remember that urgency is often the market's way of testing your discipline. Big moves create pressure. Pressure creates mistakes. The people who do best in silver are usually the ones who can stay clear-headed when everybody else starts talking in absolutes. So putting this all together, what do I think we actually have? I think we have a temporary geopolitical de-escalation, a major unwind in oil panic, a softer dollar backdrop, a still elevated volatility environment, and a silver market that finally found a reason to move with force. That is a powerful combination. It can absolutely carry further. It can also retrace before it carries further. Both are on the table. What I do not think is on the table is the idea that one headline magically solved the whole problem. That, to me, is the part investors need to resist. We're going to keep watching the next headlines, the next price reactions, and the next clues from oil, the dollar, and volatility, because that is where the real confirmation will come from. That is why tomorrow's headlines may matter more than tonight's excitement. Not from the first burst of excitement, but from what the market does after everybody has had a little time to think. And as always, this is here to help you think more clearly, not more emotionally. This is for education and market awareness only, not personal financial advice, and definitely not a command to buy or sell anything just because the tape got exciting. Take care of yourselves, take care of each other, and I will see you in the next video.